Oil prices have surged in recent days. Brent crude, a key benchmark, climbed. It reached approximately $66 per barrel. This spike occurred around May 21, 2025. The cause? Alarming news reports from the Middle East. These reports suggested Israel might be preparing an attack. The potential target was Iran's nuclear facilities. This is not a minor, fleeting market fluctuation. It signals deeper, more fundamental strategic problems. Global energy markets are now exceptionally tense. This sharp increase in oil prices means much more. It is not just a temporary reaction driven by fear. Instead, it reflects profound geopolitical and strategic issues. Tensions in the region are escalating to a critical point. The primary concern is the possibility of direct military conflict. Such a conflict would have widespread, severe consequences. This anxiety is palpable among traders and governments alike. The entire world is watching the Middle East with intense focus. Any escalation there will rapidly disrupt vital oil supplies. The stakes involved are incredibly high for all parties. Global markets are now actively pricing in these immediate dangers. The Strait of Hormuz is a significant point of concern. This narrow maritime channel is absolutely vital for oil tankers. Any disruption to passage there results in substantial costs. Even the mere threat of trouble significantly adds to expenses. Shipowners require increased compensation for the heightened risk. Insurers, in turn, demand much higher premiums for coverage. Traders automatically incorporate these new costs into their calculations. This establishes a new, elevated baseline price for future oil deliveries. A pervasive and strong sense of nervousness now fills the markets. This anxiety extends beyond any single potential military threat. There is a broader, more unsettling fear currently taking hold. People are increasingly worried that any conflict might not be contained. The old guarantees that engagements would remain limited seem to be vanishing. This situation feels markedly different from previous similar scares. Consider the events that unfolded in 2012 or more recently in 2019. The global landscape today is characterized by its multipolar nature. This means that reactions from various actors are harder to predict. We observe very specific behaviors unfolding within the oil market. The difference between spot prices and futures contracts tells a complex story. Spot prices, for oil that is needed for immediate delivery, have risen sharply. Traders are clearly anticipating that available supply might become dangerously tight. This expectation is a direct result of the potential for escalating crisis. However, futures prices for oil deliveries in subsequent months remain lower. This divergence indicates differing beliefs about how events will unfold. Some major players in the market may be hoping for a swift resolution. Alternatively, they might expect other oil sources to compensate for shortfalls. Middle Eastern state-owned investment funds are making significant strategic moves. Nations like Saudi Arabia, the United Emirates, and Qatar are notably active. They are not only buying substantial quantities of actual barrels of oil, they are also heavily investing in complex derivative contracts linked to oil. This pattern of activity is not interpreted as simple gambling on price swings. Rather, it is viewed as a carefully calculated and long-term plan. The primary objective is to protect their vital national budgets from volatility. It strongly signals their underlying belief that energy prices will remain elevated. Their influential actions play a key role in shaping broader market views. Israel's public communication strategy is also a considerable factor in this situation. Some analysts believe Israel is publicizing discussions of a potential strike deliberately. This approach could be a calculated diplomatic maneuver to test international reactions. The fluctuating price of oil itself then transforms into a powerful bargaining tool. It can be leveraged in the midst of extremely complex international negotiations. This tactic might be intended to create new space for diplomatic engagement. It could be specifically aimed at influencing policymakers in Washington and Tehran. Rising oil prices also exert considerable pressure on the current U.S. administration. Simultaneously, this price pressure also impacts Iran and its negotiating position. Large multinational energy companies are fundamentally changing their operational plans. They are managing their exposure to risk in a markedly different way now. In the past, these companies often absorbed minor, short-lived disruptions. Now, however, they are increasingly implementing fast protection emergency tactics. This new approach means they place automatic orders for additional supplies. These orders are triggered instantly when geopolitical tensions begin to rise. They also proactively secure extra shipping capacity and vital storage facilities. Furthermore, these companies are actively buying contracts to hedge against price hikes. While these are defensive measures, they can unintentionally make prices jump even more. Global energy policies are undergoing a significant and broad transformation. The current crisis in the Middle East is serving to accelerate this ongoing change. Countries are moving away from the older, more reactive energy procurement models. This previous approach was often described as a supply-on-demand philosophy. Now, a new paradigm is emerging. Stockpiling just in case becomes the norm. This fundamental shift clearly reflects a growing sense of global energy vulnerability. Nations around the world increasingly recognize the urgent need for greater energy security. This important change in thinking has very long-term implications for energy markets. It also directly influences and guides new investments in critical energy infrastructure. We can observe concrete examples of this important policy shift in action. European and many Asian nations are proving to be particularly proactive. These countries are diligently working to build up their strategic petroleum reserves. They are also making substantial investments in new liquefied natural gas (LNG) terminals. This diversification of import infrastructure gives them more supply choices. At the very same time, they are significantly speeding up renewable energy projects. This carefully considered two-part plan aims to reduce dependence on volatile regions. It represents a comprehensive, long-term strategy designed to enhance national resilience. It helps them better prepare for, and hopefully withstand, future energy supply shocks. Several different scenarios could potentially unfold in the coming weeks and months. Each of these distinct possibilities would affect oil prices in a different way. A relatively short-lived Israeli attack, met with a limited Iranian response, is one outcome. This might keep oil prices high for a period of several weeks. Then, prices could gradually decline, perhaps moving back towards $60 a barrel. However, if Iran chooses to retaliate forcefully, the situation could worsen. For example, attacks on shipping or critical oil infrastructure would cause prolonged problems. In such a scenario, global oil prices could surge dramatically, possibly exceeding $75 a barrel. This pervasive uncertainty profoundly shapes today's urgent national policy choices. Diplomatic breakthroughs could also rapidly alter the current trajectory of events. A sudden, unexpected agreement could serve to de-escalate the high tensions. If such a diplomatic solution is successfully achieved, oil prices might fall quickly. They could potentially drop to levels below $60 a barrel once more. But even with a peaceful resolution, some element of risk premium would likely stay. The collective memory of this acute crisis and its dangers would certainly remain. This lingering caution premium reflects the underlying fragility of the geopolitical situation. Global markets would consequently remain extremely alert to any new signs of emerging trouble. This sensitivity would persist for a considerable time following any resolution. The price of oil is not determined solely by factors within the energy sector. Much wider economic forces also exert a powerful push and pull on them. The complex flow of money and capital between different countries truly matters. The availability and terms of credit for traders and nations are also crucial. Significant political statements from major global powers can move markets instantly. These diverse, interconnected factors create a complex and dynamic system of influences. The global oil market is certainly not an isolated or independent entity. Instead, it often reflects the overall health of the entire global economy. It also serves as a barometer for prevailing global sentiment and confidence. Other significant external factors can also decisively sway global oil prices. For instance, China, a massive energy consumer, might start to buy less oil. This reduction in demand could occur if its domestic economy begins to slow down. Such a development could potentially offset the price hiking effect of a Middle East crisis. Actions and signals from the U.S. Federal Reserve are also absolutely key. If the Fed indicates a possible intention to raise benchmark interest rates, this impacts markets. It might consider such a move if rising energy prices fuel broader inflation. In response, investment capital could then quickly flow out of commodity markets, including oil. This withdrawal would put downward pressure on prices, complicating the overall picture. Developing countries often suffer greatly and disproportionately from this kind of instability. Nations across Africa, Asia, and South America are frequently hit the hardest. Many of these vulnerable countries import more than 80% of their total energy needs. For them, significant crude oil price hikes translate directly into sharply rising inflation. This, in turn, drastically reduces their already limited government spending power. The resulting economic pain and hardship can easily lead to widespread social unrest. This unfortunately creates a dangerous and self-reinforcing pattern of deepening instability. The consequences are felt in cities far removed from the initial conflict zone. Places like Lusaka, Dakar, Colombo, or Karachi all feel the painful impact. Energy has once again become absolutely central to global stability in the year 2025. The recent dramatic events in the oil market prove this point without any doubt. The price of oil is no longer just a simple reflection of supply and demand. It has evolved into a complex and volatile sum of fear, intricate strategy, and raw political muscle. The global energy sector now stands as perhaps the most sensitive point of global stability. It is a critical weak point that can be exploited or can simply fracture. These sudden and sharp price spikes serve as a clear and urgent warning to all. They strongly call for improved international relations and much greater global cooperation. The world must find ways to manage these energy-related geopolitical risks more effectively.